Visa and MasterCard. You've definitely heard of them before. And just in case you're stumped, you might want to pull out your debit or credit card and look at that little logo towards the bottom. It's either one of the two. Compare it with someone else's card. Again, it's either a Visa card or a MasterCard. That's just the way it's always been. Well, for as long as anyone can remember, that is. But what is Visa's business model? What is MasterCard's business model? They're on the cards issued by your banks, but they're not really banks themselves. They help secure electronic transactions, yet they don't really have a physical outlet where you can gather information on your purchases and sales. No, that'd be a bank. Then again, Visa and MasterCard aren't banks. So what are they? Where did they come from? And which one's better? You'll have to keep watching to find out. The idea behind payment processing cards. There are some things that money can't buy. For everything else, there's MasterCard. That was the late 1990s slogan used by MasterCard to gain a leg up in the decades-long payments processing network against Visa. Was it effective? Sure. It was accompanied by a heartwarming advertisement featuring a kid at a baseball game, and people really liked the idea behind it. Still, it didn't take long for Visa to catch up with an advert of their own and equalize once again. So they're both actively competing for your business. The only problem here is that many people have no idea which one to opt for. Frankly, it seems like they're one and the same. But there are differences. A lot of them, actually. The first one would be centered around their inception. Did you know that the concept of a payment processing card has actually existed since the early 20th century? Sure, there weren't automatic payment systems back in the day, but the idea of a loyalty card meant to drive business to your establishment because it offers you benefits, rewards, or even payment plans has always been there. Now, people in the early 20th century didn't have the kind of access to the world's community that we have today. So, if one establishment released their loyalty card, it was only good at that store or restaurant. For every other business, it was nothing more than paper. This changed when the Diners Club card was introduced in the 1950s. If you had a Diners Club card, you were seen as royalty. That was because the inventors of the card marketed it as an exclusive one. The cardholders were offered perks, such as deferred payment plans and discounts on anything from entertainment and food to air travel. The Visa Bank America card was introduced. Based on Diners Club's thriving business model, Bank of America introduced the Bank America card in 1958. This was considered as the world's first credit card. So far, banks would only ever offer charge cards. That is, the full payment would be paid at the end of every month. No incentives, no payment plans, nothing. It was just a card. Bank America card, on the other hand, revolutionized the game. It started off in California, but Bank of America quickly realized that in order to actually make money off the Bank America card via interest amounts, they'd have to expand it to other localities. Did they venture on a years-long journey to get there? Nope. They licensed their card to local banks in other areas that had a reach in their own community and essentially let them do the bidding for Bank of America. The MasterCharge card was introduced. The eventual Visa business model was working, and it was time to kickstart the MasterCard business model. In 1966, a group of American banks introduced the first real threat to Visa, the MasterCharge card. These banks followed the same model, licensing their cards to local banks and having them convince merchants to use their issued cards instead. This would eventually become MasterCard. In Visa versus MasterCard, one of the main differences would be their inception. MasterCard, or MasterCharge, from back in the day, was formed by a collective of banks that offered incentives on their cards almost from the get-go. These banks had a local presence and were able to kickstart an effective campaign to market their card in little to no time. MasterCard was started by a collaboration of banks to counter Bank of America's growing influence. When Bank of America realized that having a collection of banks meant stronger influence over specific branches and better networking, they also sold the rights to Bank of America in a bid to franchise. Did you know that the name Visa holds a whole lot more significance than we thought? It was an easy-to-produce word, and Bank of America realized that they needed to show international franchises they were all-inclusive. How do they make money? Easy. Service and data processing fees. However, these fees only foot a fraction of the billions that Visa and MasterCard make every year. The two companies characterize their fees differently based on their individual fee structure, such as service fees charged to issuers based on card volume. The issuer in this case would be the bank. To make a profit themselves, the bank charges merchants for each transaction. This might sound like an endless cycle of fees until one guy ends up losing at the end, but the fact is that data processing fees are usually nominal. They cover the cost of providing transactional information communicated via the network. It's the sheer volume of the amount of data that's processed every single minute of every single day that Visa and MasterCard are able to turn into a profit. That, plus loyalty card fees that are usually annual. In any event, both institutions rely on other institutions to issue their cards. At one point during the mid to late 20th century, most banks realized that it was best to just accept either of the two instead of venturing into the world of payment processing networks themselves. As such, Visa and MasterCard are both considered global leaders in payment processing and have more or less the same influence. Still, if you really want to know who has the leg up, it'd be Visa. Visa has a market cap, or net worth, of $509.75 billion as of September 18, 2023. It's a market cap that has increased by 22.47% over the past year. MasterCard's net worth, as of September 15, 2023, is $390.37 billion. They're both trading as public companies and are considered in the Fortune 500. Similarities. Both facilitate electronic transactions and offer credit, debit, and prepaid card services to individuals and businesses worldwide. As two of the most widely accepted payment networks, there are actually a lot of similarities between Visa's business model and MasterCard's business model. At the surface level, basic features are more or less the same: ownership, structure, global acceptance, and such. Both networks have security features and employ advanced technologies like EMV chips and tokenization to protect cardholder data. Visa and MasterCard collaborate with banks to issue their branded cards, providing a wide range of financial products and features to customers. These shared attributes make them reliable choices for convenient and secure electronic payments across the globe. However, to have one leg up over the other, the two payment processing networks routinely offer loyalty or premium features. Differences. Visa versus MasterCard. The two have different numbering schemes for their cards. Visa's card typically starts with a 4, while MasterCard starts with a 5. Visa also has a program called Visa Signature that offers additional perks and benefits on some of its premium cards. MasterCard, on the other hand, offers a program called MasterCard World with enhanced benefits on certain premium cards. Starting with Visa Signature, the cards generally come with higher credit limits compared to standard Visa credit cards. But that was pretty much expected. The real benefits are travel, emergency services, purchase protection, and a whole host of discounts. It provides coverage in case of accidents while traveling on a common carrier, such as an airplane or a train. Visa Signature's travel benefits don't just end there. Cardholders often have access to a 24/7 concierge service that can assist with travel planning, reservations, event tickets, and more. That is, though, if the ticket is purchased with the Visa Signature card. Traditional Visa cards offer many protections, including zero liability for fraudulent charges, emergency card replacement, and emergency cash disbursement. Additionally, some Visa Signature cards also provide cell phone protection, emergency medical and dental coverage, price protection, return protection, emergency evacuation, extended warranty, and purchase protection. Now, the discounts. Did you know that Visa Signature card holders may have access to exclusive events, offers, and discounts, including dining, entertainment, and shopping benefits? Visa Signature cards often come with rewards programs that allow cardholders to earn points, cash back, or miles for their spending. On to MasterCard World now. MasterCard World provides its own set of exclusive offers and experiences, which could include access to MasterCard Priceless Cities experiences and special privileges with certain travel and lifestyle partners. When it comes to protective services, MasterCards are generally favored. This is because they offer, in addition to features listed for Visa Signature, cell phone protection plans on all cards, even those that aren't part of the World line. Where it shines in its protective services, unfortunately, the MasterCard World lacks in travel protection. Historically, MasterCard World offered many of the same features as Visa Signature. However, they've recently limited travel options. That's about it for this video, but don't worry, we have a whole lot of videos on credit cards, debit cards, and just about everything on any and everything that has to do with finances waiting for you.